Good morning, David. You are the manager of Sparinvest Ethical Emerging Market Value Fund. Emerging market has performed quite bad since 2011. Why should you consider investing in emerging market right now?
Well, I think it's true that it's been a difficult period for emerging market equities over the last few years. I think that the most basic point to make is that this has been a period where emerging market GDP growth at the aggregate level has been decelerating relative to developed markets. And typically when you see that happening, you see outflows from emerging markets and you can have some weakness in the equities, at least relative to developed markets. Going forward, we think, if you look at IMF forecasts, but an increasing number of expectations, there's reason to believe that emerging market growth relative to developed markets will be accelerating again, and we think that could be something of a supportive factor for emerging market equities over the coming few years. Another factor is that emerging market currencies have been relatively weak. You've had high levels of inflation, which certainly doesn't help those currencies. And if you look at certain markets and at the aggregate level, we think there's ground to believe that inflation in many of these emerging markets could ease going forwards, and that could well be a tailwind, or at least a supportive factor for some emerging market currencies.
Okay. You're a value manager, and we know that value empirically outperforms growth over time. But since 11, that has not been the case. Why is the time right now?
Well, it's true that while it tends to outperform empirically in the longer term, there are always periods of underperformance, and the last few years have been one of those periods. One simple factor is that the longer that such a period of value underperformance lasts, the deeper it goes, the more potential there could be for a reversion. So from a diversification perspective, it's worth considering taking some exposure to value, we think. But another factor is slightly counterintuitive, and it's that if you're looking at growth picking up in emerging markets, typically during those periods, it's not actually growth stocks that are outperforming, it's often value stocks that outperform. And a simple reason is that as you get more growth in the market overall, specific growth stocks benefit less from a growth scarcity premium, and you can see value stocks become more relatively attractive. Another point to note is that while value stocks have been having a bit of a tough time in the last few years, they have been getting consistently cheaper relative to growth stocks. If you compare simply the price book or the price earnings ratios of value stocks relative to growth stocks in emerging markets, they look cheap. And finally, difficult to go into depth on this one now, but if you look at the potential for rate hikes or a slight steepening of the yield curve in the States and arguably in other developed markets over the coming years, that can be a tailwind for value. If we look at the way things have worked historically, typically as you see in that slight steepening, that's a bit of a supportive factor for value stocks. So we think there's good grounds for value to start to have some support going forwards.
Yes, okay. And if I buy your fund, what kind of portfolio would I then get? Could you give me some example?
Yes, I think you get a diverse portfolio of stocks that have been researched from a bottom-up perspective so that we are confident that when we invest, they have a significant discount in the current market price relative to what their intrinsic value is, what we think they're really worth in the long run. It's a portfolio that has been ethically screened for breaches of certain international norms and also exposure to certain sectors. And I think overall it's a portfolio that tends to have somewhat low valuations compared to, for example, a general emerging market benchmark. It also has some small and mid-cap exposure because we think that's also an important potential driver of returns in the medium to long term.
And having a look at your fund, it has performed tremendously good since you started 2012. To this year, you're almost 4% ahead of the benchmark. Why is this? Why is it going so well?
Well, as we've already discussed, it's not been a great period for value overall. That hasn't been a tailwind that's been working for us, and we think that should be a tailwind over the long term. But in the last few years since launch, and indeed year to date, the key driver has been the selection of individual stocks, the returns we're getting from our stock selection. If we talk specifics, year to date, it's diverse. One very strong performer has been Mando, which is a small cap South Korean maker of auto parts. There's Buenaventura, which is a Peruvian gold miner, and that's obviously benefited from changes in the gold price. There's Yes Bank, which is an Indian bank, but some diverse performance across a wide range of stocks. And as fundamental investors, of course, we're quite pleased to see that our stock selection is paying off in returns.
Okay, thank you, David. Thank you for joining us today.
Thank you very much.